Hi, I'm Chris Days and I'm the founder of Go Mortgage, and I've spent over 22 years helping homeowners across the UK buy their dream home, even if they thought it wasn't possible. At Go Mortgage, we keep mortgages jargon free, simple, and totally tailored to you. Whether you're a first time buyer, have bad credit, and self employed, or just generally want to know how things work, we're here to guide you from scrolling Rightmove to getting your keys. I'll be sharing real client stories, insider tips, giving you straight talking advice, no fluff, no nonsense, just what you actually need to know. If that sounds like your kind of mortgage advice, hit subscribe, drop me a thumbs up, and let's get things moving. Hi, and welcome. Today we are going to talk all things mortgage jargon. First one is LTV. What is LTV when we talk about that? So, LTV is loan to value. What does that mean? Most people don't understand it. Breaking it down really easy for you. You've got a property that's worth £100,000 and you have a £10,000 deposit. So you have a £90,000 mortgage. That means that your loan to value bracket would be 90% because you're borrowing 90% of the value of the property and your deposit is 10%. So that is loan to value, broken down really easy. Fixed rate. What is a fixed rate? So you get two types of rates, fixed and variable. Fixed is fixed for a period of time. Typically in the UK, the most popular are 2 and 5 years. However, you'll get 2 year fixed, 3 years fixed, 5 year fixed, 10 year fixed, and you're fixing your rate for a period of time. So if you do a 2 year fixed, your monthly payment is going to be fixed for 2 years. And no matter what happens with the Bank of England base rate, your rate remains constant, it remains the same. So if your monthly payment is 500 quid on your fixed rate, it's going to be £500 for 2 years. At the end of your 2 year fixed rate period, you would revert to the lender's standard variable rate if you don't do anything. But by then, if you were with us at Go Mortgage, we'd be reviewing your mortgage and we would do a remortgage to basically look at another fixed rate for you. So that's a fixed rate. What is a variable rate? So a variable rate is something that varies. So it might be a discount, a tracker, a discount, or an SVR, a standard variable rate. So all these rates are going to be directly affected by the Bank of England base rate. If the Bank of England base rate fluctuates, your monthly payment could increase or decrease. So that means your monthly payment isn't fixed, it's varied. And the benefit of a variable rate is that you have the flexibility a lot of the time that you have no penalties. So you can redeem your mortgage or you can part repay it whenever you want. You have the flexibility, whereas a fixed rate, you're fixed for that period of time. And if you wanted to do anything, you're going to have penalties for doing so. So variable rate is good for people who want flexibility. However, you could potentially have increases if the Bank of England increases the rates. But on the other hand, if the rates got reduced, you could benefit from lower payments. So it's varied. That's a variable rate. What is a remortgage? So when your mortgage is in, let's say you're on a 2 year fixed rate and your mortgage is coming up for renewal, a remortgage is where you review your mortgage and you basically take the mortgage from one lender to another lender in order to get the best rate that is available at the time. At the time of remortgage, you can do a like for like remortgage. So you can take your £100,000 mortgage that's over 25 years and you can do it £100,000 over 25 years with the new lender and just get a better rate. At the same time, you can also assess things. So you might want to get your mortgage paid off quicker. You might reduce the term of years. You might want to you might have got a job where you're on less money. You might need to make things cheaper. You might extend the term. If you've got equity in your property, you could remortgage and pull equity out. So remortgage time, it's a good time to review your mortgage and assess where you're at and assess what you want to do. If you found this helpful, hit like and subscribe and share this video with someone who's looking to buy their next property.